What happens when easy credit becomes a quiet crisis? In India, rising private debt is fueling growth, but also deepening financial vulnerability. What happens when easy credit becomes a quiet crisis? In India, rising private debt is fueling growth, but also deepening financial vulnerability. Private debt includes borrowing by individuals and businesses outside traditional banks, through NBFCs, peer-to-peer platforms, microfinance institutions, and informal money lenders. It boosts consumption, investment, and entrepreneurship. But when it grows unchecked, it can destabilize households, firms, and the economy. In rural India, total credit is estimated at Rs 18 to 20 lakh crore, with about 40% of households relying on informal sources. Interest rates can range from 24% to 60% per year. Meanwhile, NBFC assets rose to 45 trillion by 2023, P2P platforms grew to around 350, and informal moneylenders are estimated at 500,000, evidence of rapid expansion outside formal banks. Households increasingly use personal loans and credit cards to bridge income gaps, especially since COVID-19. Many juggle loans from MFIs and informal lenders, risking default. MFIs and P2P expand access but often at higher rates, 18% and 14% on average, compared to about 9% from banks. In many rural areas, informal moneylenders charge exorbitant rates, pushing families into debt traps. When borrowing shifts to high-cost private credit, it can crowd out lending to productive sectors like manufacturing and infrastructure. SMEs face a tough choice: accept expensive P2P or NBFC loans or stall expansion. In rural economies, high interest obligations force short-term decisions over long-term investment. High informal rates blunt RBI's rate cuts. A parallel credit market weakens monetary transmission, complicates inflation control, and expands the informal economy, making policy less effective and inequality worse. The gap is stark. Informal credit can cost several times more than bank loans. For a small shopkeeper or farmer, a 30% loan can mean constant stress, servicing debt over investing in growth, education, or resilience. For a small shopkeeper or farmer, a 30% loan can mean constant stress, servicing debt over investing in growth, education, or resilience. Financial inclusion has expanded through Jan Dhan and Mudra. MFIs operate under a 24% cap. Regulators are prosecuting malpractices, yet enforcement is hard against a vast informal network. Many accounts remain dormant, and loan quality issues persist. Strengthened surveillance of NBFCs, P2P, and informal lending ensure fair pricing norms and prevent predatory practices. Make debt restructuring and bankruptcy processes faster and borrower-friendly to reduce defaults and contagion. Expand alternatives to debt. Deepen corporate bond markets, equity, and venture funding so firms don't overborrow. Scale financial literacy, set prudent debt-to-income norms, and promote comparison tools so borrowers choose wisely. Prioritize inclusive, sustainable growth. Channel formal credit to infrastructure, manufacturing, and innovation to reduce dependence on high-cost loans. Private debt can power growth, but without guardrails, it fuels instability. With robust regulation, smarter credit options, and financial education, India can turn credit into a driver of sustainable, inclusive development.